9:48 de la mañana y avanzamos en Negocios Televisión y vamos a acercarnos ahora al análisis mirando a la situación del mercado y a la inversión, y para hablar de ello nos acompaña Brian O'Reilly, responsable de estrategia de mercado de Mediolanum International Funds. Brian, good morning.
Good morning. Thank you for having me on your program.
Thank you for joining us in Negocios Televisión. Brian, economic conditions appear to be weakening. What is your assessment of the global economy as we reach the halfway point of the year?
Sure. I mean, if we think back to the beginning of this year, I think most economists and economic forecasts were quite bearish and gloomy. And the reasons are understandable. The combination of the highest level of inflation since the 1970s and very rapid increase in central bank interest rates all conspire to take a toll on consumers. I'm glad to say, as we reach the halfway point of the year, that worst case scenario hasn't transpired. And while there are some areas of weakness, particularly in the manufacturing sector, and of course in China, the world's second largest economy, where its post-COVID recovery just simply hasn't matched what we've seen here in the West. So they are two main areas for concerns. But if I look at the reasons why the economy is not worse than was predicted at the beginning of the year, I see two main reasons. One, obviously a lot of pent-up demand from households and consumers as we come out of the pandemic. And secondly, what we do know is that households have amassed quite a large amount of savings as they were either unwilling or unable to spend during the pandemic. So that's a key positive in my view. So the outlook from here really depends on two things. The first is how quickly will inflation get back to some type of levels that central banks are happy with, and secondly, how many more interest rate hikes will we need to see before we hit, the magical 2% target? And that really is the key question, I think, for the second half of the year, whether central banks can engineer a soft landing or whether a recession is inevitable.
Inflation continues to remain high in Europe, and the ECB are committed to raising interest rates. When do you think inflation will fall and the ECB will stop raising rates?
So that's the key question that market participants are grappling with at the moment. It is the single biggest challenge. We are faced with persistently high and what's known as sticky inflation. And as much as we know that the war triggered this sudden spike in inflation last year with oil and gas prices soaring, today oil and gas prices are actually below where they were pre-pandemic. So inflation is much broader and has spilled over into other areas of the economy, like food and housing. And again, parallels to the 1970s, what we do know, once inflation gets out of control, it is very, very difficult to get it back into the bottle. And that is why we continue to see central bankers talk tough on inflation. Recent comments from ECB President Christine Lagarde were very hawkish, focusing on the need to do more to get inflation under control. And that's likely to be one of the key focus when policymakers meet in Portugal this week. I think the problem is even more complex in Europe. Again, we know, the Eurozone is made up of many different nations with very different economic dynamics. We see inflation in Germany above 6%. We see Italian inflation above 8%. Spain is leading the pack in terms of the fight on inflation, just above 3% inflation. And that, in fact, is expected to fall below the ECB target in Spain next month to just 1.7%. So the ECB have quite a challenge on their hand to set the appropriate interest rate policy to take account of all these different national interests. In terms of what we think will happen, we think we will see another rate hike over the next 2 months from the ECB and one more in the third quarter. But after that, we think the fight on inflation will be largely won. It is on a downward trajectory, and that should allow the ECB to pause their interest rate hikes and try and engineer that soft landing.
The market is being driven by mega-cap technology stocks in the US led by developments in AI. What do you think will happen next? Will they continue to dominate the market?
Yeah, it's been the key feature of markets this year, the surge in technology stocks driven by, the emergence of artificial intelligence and GDP. So while economic growth has been, on the weaker side, the stock market is up almost 10% year to date. And if we dig a little deeper in terms of the subcomponents of the market, we see the Nasdaq up an incredible 30% year to date, and stocks like Nvidia 190%, Meta up 140%, Meta's Facebook, and Microsoft up 40%. So while the market as a whole is doing very well, and technology in particular is extremely strong, it is very concentrated in just a few stocks in the market. And in fact, for the rest of the companies that make up, say, the S&P 500, they have been relatively flat year to date. So it's not necessarily a healthy market in terms of its breadth. It is quite a narrow market. So the question now is, have these technology stocks come too far too fast? Certainly when we have a look at some of the valuations in the tech sector, they remain quite elevated after their recent run. So for me, one or two things have to happen. One, either we will see a pullback in the market, and those stocks that have risen the most this year will probably come off the most in that scenario. Or two, markets can continue to grind higher, but we will need to see a greater breadth in the market. And for some of the companies that have been left behind in industrials, healthcare, financials, etc., play catch up with some of these bellwether technology names.
Mm-hmm. What is your key piece of advice for investors for the remainder of the year?
So I think the key lesson is, despite, doom and gloom out there about the direction of the global economy, the lesson from the first half of the year is that markets have a tendency to surprise on the upside. And that's essentially what we're seeing here. I think ultimately whether you're bullish or bearish from here will depend on your belief on inflation. Certainly ours here, we will see inflation continue to fall. And if we are right and central banks can pause their interest rate hike, studies we've done looking at previous rate tightening cycles, when central banks stopped raising interest rates over the last 8 times since the 1980s, in 7 occasions markets have been higher on average between 10 and 15% over the next 12 months. There was only one episode where markets were weaker after such a scenario, and that was in the 2000s, where we did have a technology bubble. So our advice is that certainly for investors with a longer term perspective, any weakness in the market, any pullbacks should be seen as a buying opportunity to buy both equities at better valuations, or indeed fixed income and bonds, which are now delivering decent levels of yields for more conservative investors.
Thank you for this interview, Brian O'Reilly, responsable estrategia de mercado de Mediolanum International Funds. Thank you, good business, a good day.